If you take one thing away from this channel, let it be this. Risk management is the only part of trading that decides whether you're still around in 5 years. Not your entry model, not your indicator, not your win rate. Risk management. I say this as someone who spent my first couple of years completely ignoring it, jumping between strategies, sizing positions based on how confident I felt instead of actual math. It's the kind of mistake that doesn't punish you immediately, it punishes you eventually. All at once, on the one trade where everything goes wrong. So today, no jargon, no complicated formulas you'll forget 5 minutes after watching this video. Just risk management, explained as simply as I can make it. Because if you understand this one topic, you'll already be ahead of a huge percentage of traders.
Let's start with what this actually means, because a lot of traders think risk management simply means using a stop loss. That's part of it, but it isn't the whole picture. Risk management is the set of rules that decides how much of your account you're willing to lose on any single trade, any single day, and any single losing streak. And those decisions are made before you enter the trade, not while you're already in it with your emotions involved. Think of it this way. Your trading strategy decides when you enter and exit. Risk management decides how big that decision is allowed to be. Imagine two people driving the exact same car. One wears a seatbelt, obeys the speed limit, and pays attention to the road. The other ignores every warning sign and drives recklessly. The car is exactly the same. The difference is how it's managed. Trading works the same way. Your strategy gets you into the market. Risk management determines whether you survive the journey.
You can have the best entry model in the world, but if your position sizing is reckless, the strategy barely matters. One bad trade can erase the edge of 100 good ones. That brings us to one of the most common rules you'll hear, the 1% to 2% rule. Never risk more than 1 to 2% of your total account on a single trade. Here's why that number matters. If you risk 2% per trade, you can lose 10 trades in a row and still have roughly 80% of your account left. If you risk 10% per trade, 10 losses in a row effectively ends your account. Losing streaks aren't unusual. They're not a sign your strategy is broken. They're an expected part of trading. The percentage you choose determines whether a losing streak becomes a bad week or the end of your trading journey. Risk management doesn't make money, it protects your ability to keep making it.
This is where most beginners go wrong, and I was one of them. They decide their lot size based on gut feeling instead of calculation. The correct order is simple. First, decide where your stop loss belongs based on your analysis, where the trade is actually invalidated, not an arbitrary number. Second, decide what percentage of your account you're willing to risk. Third, let those two numbers determine your position size, not the other way around. If your stop loss is further away, your position size should become smaller. If your stop loss is tighter, your position size can be larger. What stays exactly the same is the amount of money you're risking. Most beginners reverse the process. They choose a lot size that feels right, then move the stop loss until it fits. That means their actual risk changes from trade to trade without them even realizing it. Consistency starts long before you enter the market. It starts with how you size the trade.
A stop loss only works as risk management if you treat it as final the moment you place it. One of the most common beginner habits, and one I've been guilty of myself, is moving the stop loss further away once a trade starts going against you. We tell ourselves we're giving the trade more room to breathe. We're not. We're turning a small planned loss into a large emotional one. If your analysis was wrong, then the trade should be allowed to be wrong for a small predetermined amount. That's the entire purpose of placing a stop loss before you enter. You're making that decision with a clear head, not in the middle of a losing trade when fear is making decisions for you. The moment you move your stop loss, you're no longer following your plan. You're negotiating with your emotions. The market doesn't care how convinced you are. Your stop loss exists because you might be wrong. The next piece is risk to reward ratio, which simply compares how much you're willing to lose with how much you expect to make. If you risk $100 to potentially make $100, that's a 1-to-1 ratio. If you risk $100 to potentially make $200, that's 1-to-2. It sounds simple, but this one concept completely changes how often you actually need to be right. With a 1-to-1 ratio, you'll generally need to win more than half your trades just to stay ahead after trading costs. With a 1-to-2 ratio, you can win less than half your trades and still come out profitable over time. That's why judging a strategy by its win rate alone is one of the biggest mistakes beginners make. A strategy that wins 40% of the time with a 1-to-3 risk-to-reward ratio can outperform another strategy winning 70% of the time with a 1-to-1 ratio. Win rate tells part of the story. Risk to reward tells the rest.
Risk management doesn't stop once you've entered a trade. It also decides what happens when things aren't going your way. Real traders don't just have limits for individual trades. They have limits for bad days, bad weeks, and sometimes even bad months. A practical daily rule might be this. If I lose 4 or 5% in a single day, I stop trading. No exceptions. Why? Because your worst trading decisions almost never happen on your first trade. They happen on your 4th or your 5th, after frustration has quietly taken control. That's when overtrading begins. That's when revenge trading appears. And that's when a manageable loss suddenly becomes something much bigger. Stepping away isn't weakness. It's part of the plan. Sometimes the smartest trading decision you'll make is deciding not to place another trade. Protecting your capital also means protecting your mindset.
One part of risk management that beginners consistently overlook is managing exposure around high-impact news releases. Events like CPI, interest rate decisions, or major employment reports can move the market in seconds. During those moments, price isn't behaving normally. It's reacting to new information faster than technical analysis can keep up. A perfectly reasonable stop loss can be skipped over because of slippage, leaving you with a larger loss than you originally planned. A simple rule that has helped me over the years is avoiding new trades during the 15 to 30 minutes surrounding medium and high impact news, unless I have a strategy that's specifically designed for that volatility. This isn't about fearing the news. It's about respecting what the market is capable of during those moments. Good risk management isn't about avoiding opportunity. It's about avoiding unnecessary exposure.
Here's the part that actually separates traders over the long term. Everything I've explained so far is genuinely simple. You could write every one of these rules on a single index card. The hard part was never understanding them. The hard part is following them. On the one trade where you're absolutely convinced you're right. The one where everything inside you says, risk a little more, move the stop loss. This time is different. That's the moment risk management is really being tested. Not when trading is easy, but when your emotions are trying to rewrite the rules you've already made. Execution consistency, not the sophistication of your strategy, is usually the biggest difference between traders who survive and traders who don't. Simple rules create consistent traders, only if they're followed consistently.
Risk management is the most boring part of trading.
And that's exactly why it works. It's not exciting. It won't generate millions of views the way a video promising a secret strategy might. But it's the difference between the trader who's still here 5 years from now and the trader who's blown 3 accounts and quietly walked away. If you take nothing else from this video, remember these 3 things. Decide your risk before you enter. Size your position based on your stop loss, not your gut. And once your stop loss is placed, respect it. Everything else you build as a trader rests on that foundation.
If this video was useful, let me know in the comments what your current risk per trade is.
I'm genuinely curious how many of you are calculating it versus simply eyeballing it, because that's often where the difference begins. Every blown account starts with a trade someone believed was worth breaking their own rules for. Don't let that trade be yours. If this episode helped simplify risk management, I hope you'll carry these ideas into your next trading session. Not because they'll stop you from losing, but because they'll stop one loss from becoming something much bigger. And over the long run, that's what keeps traders in the game. This has been another entry in Trader's Journal. Until next time, keep learning, stay disciplined, and I'll see you in the next one.